Okay, good morning. This is the second sitting for the year of the New York City Housing Authority Audit and Finance Committee meeting. I want to welcome all of us who are here present at this meeting. Vice Chair Gonzalez, we want to welcome you. Mr. Kaplan, indeed, we are grateful to have you and your invaluable service. Mr. Koo, we continue to appreciate your long service that you render to us. And Miss Emma Wolf, we are happy to have you. This is the first time we are all meeting in person for some time, and as such, we are indeed grateful. Our visitors, we want to welcome you. Those who are watching online, we are welcome you. And also our external auditors who will have most of the presentation today. We want to welcome you, Jill and her team from Deloitte. Also our finance department, Jeff, Anika and her team. We want to welcome you also to this meeting. We want to encourage you, those who are present in the room, that your cellular phone is placed on silent or vibrate so that we have minimum disruption as we proceed in our meeting. We will now go straight to our agenda. But before I do that, I want us to quickly have the roll call to ensure that we are able to start the meeting with the appropriate quorum. Anil?
Yes. Hi, good morning, everyone. So we have with us today Mr. Gonzalez,
Present.
Mr. Mark Kaplan, Mr. Richard Koo, Ms. Emma Wolf,
Present.
and then from finance side, we have Jeff Lesnoy,
Present.
Adam Chukri,
Present.
Okay. And we have from Deloitte, Jill Strawmeyer.
Here.
And we also have Darshan Patel from Deloitte.
Present.
Okay, we can start the meeting. We have the quorum in terms of the audit committee members.
Thank you. Thank you very much, Anil. By way of apologies, our Executive Vice President, Anika Lescott Martinez, unable to be here. Also, our VP for the Internal Audit Department, Ms. Vilma Uratas, also conveyed our apology for absence. We will proceed with our agenda as outlined. And the first thing on our agenda is the approval of the Audit Committee minutes for February 8, 2022. Hope we all had a chance to go through the minutes. And if so, I'll entertain a motion that the minutes be accepted as presented. That's been moved by Mr. Koo, seconded by Mr. Gonzalez. All in favor? I have it. Opposed by any sign?
I'd like to leave my copy with some minor edits.
And this is to the minutes, Mr. Kaplan?
I'd like to leave my copy with you with some minor edits.
Oh, sure. We appreciate that, Mr. Kaplan. Thanks much.
Yeah, so we'll collect that at the end of the meeting, and then we'll make the necessary changes, I guess. Yeah.
Thank you. We continue with our agenda, and the next item we want to present is the New York City Housing Authority. That is a consolidated annual comprehensive financial report for the year 2021.
Good morning, Audit and Finance Committee members. My name is Jeffrey Lesnoy. I'm the Vice President of Finance and Controller. Earlier this week, a full set of annual financial statements were distributed for your review as it relates to the years December 31st, 2021 and 2020. This included financial statements for each of the following: New York City Housing Authority, Nycha Public Housing Preservation 1 LLC, Nycha Public Housing Preservation 2 LLC. Such financial statements are comprised of statements of net position, related statements of revenue and expenses and changes in net position, and statements of cash flows, and the related notes to the financial statements presented in conformity with generally accepted accounting principles, GAAP. Also included is management's discussion and analysis and required supplemental information to be read in conjunction with the financial statements. The financial statements are being provided in order to afford members a comprehensive understanding of the financial activities of the entities for the years presented. It should be noted that only one accounting standard adopted in 2021 was GASB Statement 98, which introduced the Annual Comprehensive Financial Report as a replacement of Comprehensive Annual Financial Report, simply a name change. Excuse me?
A waste of time and money.
Perhaps. As it is not practical to walk through each page of the financial statements, I intend to first focus on issues that have impacted the financial statements broadly, and then walk through the statements at a high level. I think our members have a handout that they can refer to as I talk through this. So I think the first major driver of activity in 2021 and 2020 for that matter were the PAC transactions, the Permanent Affordability Commitment Together. We closed 3 related transactions in December, all structured as 99-year leases. 6 developments were involved, about 5,200 units, including Boulevard, Belmont Sutter, Fiorentino, Pennsylvania Avenue, Wortman Avenue, Linden, and Williamsburg. The goals of PACT are to facilitate conversion of apartments from public housing funding to Section 8, to allow developers to finance necessary building repairs and operational improvements, all while preserving long-term affordability. The Nycha compensation on these PACT transactions included $33 million of additional amounts received in the form of debt repayments for respective developments. Revenues to be recognized over a 40-year period based on the authority's purchase option. We have $8 million of developer fees received at closing, and Nycha's share of an additional $50 million of developer fees expected to be received beginning 2025. The revenue to be recognized over the conversion or rehab period on the properties. We also have purchase money notes, $217 million collectively between the 3 transactions. These are sometimes referred to as seller's notes. Amounts to be repaid out of developer's cash flow over a 40 to 44-year term. Due to the uncertainty of cash flows, Nycha has established a 100% allowance for doubtful accounts on these notes. Revenues will be recognized over the 40-year period, only after payments are received. The next major driver affecting our business during the year, in 2020 for that matter, was COVID-19. Nycha implemented emergency protective measures to sanitize facilities and provide safety to its residents and employees. Incremental costs included within the public housing program were $58 million in 2021 and $78 million in 2020. Also, incremental costs within the Section 8 program were $27 million in 2021 and $10 million in 2020. On to incremental funding, which we received as a result of COVID. Due to the CARES Act grant for public housing, we drew down $150 million, of which $120 million was drawn down in 2020 and $30 million in 2021. Note that the CARES Act allowed for funds to be used to prevent, prepare for, and respond to COVID, in addition to using to fund normal operations. CARES Act grant for Section 8 was $37 million, drawn in full in 2020, but recognized $10 million in revenues in 2020 and the balance in 2021 in accordance with the cost incurred. All CARES Act funds were expended by year-end 2021, which was the expiration date. FEMA funds received in response to COVID were $15 million in 2021 and $9 million in 2020, covering 75% of eligible costs with a 25% cost share. In addition to increased costs and ability to draw on additional funding sources, we had impact on our rent collections that were pretty significant. We know COVID-19 had a direct impact on the local economy, as well as impacting tenants' ability to make rent payments. To put things in perspective, 2019 rent revenue was $1,058 million, decreased by $91 million in 2020 to $967 million, and further decreased by $46 million to $921 million in 2021. So in 2 years' time, we had about $146 million drop, $137 million drop, excuse me, in 2 years' time in tenant collections. These are large decreases and required the authority to substantially increase the allowance for tenant receivables to $286 million at December 31st, 2021. In contrast, the allowance at December 31st, 2019, a pre-COVID date, was $72 million. So we increased our allowance for doubtful accounts by $214 million in that 2-year period.
I want to go back just a moment to the beginning so that I understand a little better. So in the second page, or actually the first page of the presentation, you say, in short, little to no revenue recognized in 2021. Now, when they start doing the conversions, right, some are completed within the year, and then you have some that are pending. Now, I know that there are expenditures during the time that they're doing the conversions. So is that reflected in here, and is that part of the problem why we don't show any revenue recognized?
The accounting standards require that we recognize over the period of time, over the rehab or the conversion period for developer fees. The costs will obviously be incurred over the same time, but most of those costs will be incurred at the developers, not on Nycha's books.
I see. Okay. So we won't show any revenues until the entire project is complete?
We will recognize the developer fees over the conversion period. If the conversion period is 2 years, then we'll recognize it over a 24-month period. Every month we'll recognize 1/24 of the developer fee.
Okay.
So it has a short band for developer fees, but for other type of acquisition fees, like a debt repayment or an acquisition fee that we receive up front, that will be amortized over a much longer period of time. It's generally the lease term or a shorter period, which could include the purchase option or right of first refusal option. So it depends on the circumstances and the transactions of the deal. But in this case, for these deals, those larger revenues we're receiving are going to be amortized over 40 years.
Okay.
So considering we close these transactions 3 days before year end, we really recognize no revenues in 2021.
Okay. So basically anything else that will show up will be into the following year?
That's correct.
Okay.
But the other point is we've closed many other PAC deals in previous years, and we are recognizing or reaping the fruit of those transactions in 2021 and 2022, et cetera. It's just taking time to amortize into the portfolio.
All right. Thank you.
Can I ask a quick question on the next section that you just went over on the COVID costs? This is a small question, but I'm just sort of befuddled by it. Why a jump from 10 million to 27 million for Section 8 COVID costs from 2020 to 21, when for public housing it went down considerably? Do we have any idea?
There were options as far as how to draw down, so it wasn't restricted based on costs incurred. If we incurred $50 million of costs but only wanted to draw down $10 million, that was an option we had. And with the CARES Act, the funds were not limited just to COVID-19, prevention and preparation for. They were also allowed to be used for normal operating costs. So we had the opportunity to budget for it based on our overall financing needs. Well, while we can't scientifically attribute every rent collection decline to COVID, the general change in the economy, its disproportionate impact on low-income households, in addition to moratorium evictions set by federal and local laws, all had significant impact on rent collections over this time period. Nycha Finance invested significant effort in applying for or supporting applications of $118 million from the New York State Emergency Rental Assistance Program, called ERAP. These applications represented 31,000 Nycha households. However, with ERAP's limited funds and New York State's decision to assign lowest priority to public housing residents, no ERAP funds have been made available to Nycha or its residents. Before I go on to the next driver, are there any questions on the COVID impacts?
Did we contest this, did we contest the decision not to make those funds available to us?
There were a lot of discussions regarding the COVID, but they're still ongoing at the state level.
So they just unilaterally decided to do it.
Correct.
Without regard to the facts.
Yep. Correct.
Yes.
Correct.
Unfortunate.
They looked at it as double dipping, which seemed to be a very unfair way of doing that the residents had already received federal funding, federal subsidies and benefits. I mean, I think that's the wrong approach, but, we weren't able to change that.
I'm having lunch with the state senator today. Maybe you should talk to me about it.
We'll brief you after the meeting, so maybe you'll have better luck than us.
The third major driver revolved around pollution remediation obligations, lead-based paint. New York City Local Law 1 requires landlords to take actions to prevent lead poisoning in children under 6 years. Historically, the New York City standard defined lead paint at greater or equal than 1.0 milligrams of lead per square centimeter. Consistent with the 2019 agreement with HUD, Nycha agreed to perform annual visual assessments, perform remediation, abate lead in all apartment and common areas within a 20-year period. The federal standard for lead is also set at 1.0 milligrams. To date, the authority has tested approximately 80% of the target population, defined using the 1.0 milligram standard, with approximately 27% of the apartments reflected as positive for lead. However, effective December 21st, 2021, New York City has a new stricter standard, Local Law 66, for measuring the presence of lead in paint, defined as 0.5 milligrams of lead. Under the new standard, Nycha will be required to test substantially all apartments at move-out, even those Nycha previously tested. In addition, Nycha has initiated a program to aggressively retest all apartments. There are approximately 32,000 with children under 6 years of age by January 2023, and will ensure testing for any newly identified apartments with children under 6 and involved. Currently, test results.
Thank you. Why, if the federal government, which is primarily funding the HUD, the Nycha program through HUD, if that's the 1% standard, then why are we following the local law, 0.5%, which is city law, not federal law? In other words, federal EPA requires the 1%. Why are we following the New York City law of the 0.5% when most of our buildings are federally funded? It's a city law, but HUD is funding. Federal government is funding these buildings. Are we not required to follow the federal law as opposed to the local law? That's a question. I'm not.
Yeah, it's a good question. In my understanding is we need to follow the strictest law for the geographical area that we're located in. we've discussed this with our legal team, our compliance team, and they all seem pretty clear that this is something that we need to implement in 2021.
I don't think there's any question about that. You're right.
Well, have we gotten a separate opinion from the law department?
I haven't seen a legal opinion, but our legal department has been directly involved in this process.
Because there's big bucks involved here in terms of not only current remediation efforts and looking at possible testing and so on, but, it could potentially increase significantly the liability of the lead paint. So I'm just raising that as a question, which I would really appreciate Nycha looking into this further before, because I noticed all the financial statements have been modified to include the 0.5% as opposed to the 1% on the liability side.
Yeah, I agree. It's a real issue, and it's something that we can look into with our legal department and ensure the documentation is all lined up.
No, I understand from a legal point of view this may be the case, but again, the local law could be amended tomorrow.
I have a question. Being one of those residents who went through the testing of the lead, are we looking into the particular companies or agencies that did the initial XRF training, testing, and then comparing it to what we're currently going through now and see if there's a big variance? Because I understand that in those testings, one of those testings is a placebo. And that's just to see if they're actually getting proper results. So are we following up on that as well?
I'm not clear exactly what the question is.
Okay. We did, initially, Nycha came and did some testing, the XRF testing, okay? And they got their results. And they based the following movements as to what needed to be abated and what needed not to be abated, and which apartments had it and which apartments didn't have it. And then they also came up with something where it shows you the degree of the test of the lead. Now we have the government or someone else coming in to redo this testing, which is another extra expense, but that's not the part of the question, is are we now going to compare the findings that we had before to the findings that we have now to make sure that they're accurate and they're actually looking into the lead issue so we can do the proper abatement?
I'm not sure I can answer that question, but I can certainly take a note and look into it and get your response quickly.
Thank you.
Okay, if there are no other questions, I'm going to continue talking about the lead paint topic. Currently, test results using the new 0.5 milligram level represent only about 5 to 10% of the apartment units and are dispersed across only a dozen or so developments. So given this, the test results at the 0.5 level are insufficient to reliably estimate lead paint findings across the portfolio. Therefore, current estimates used within the pollution remediation obligation incorporate cost to abate based on the 27% positivity rate at the 1.0 milligram level. The positivity rates at 0.5 and related costs are likely higher, but the authority cannot reasonably estimate at this time. GASB 49 requires that costs to be recorded only if they can be reasonably estimated. So we have to wait until we can do some more substantial testing, which may not be until mid-2023. So as a result of increased cost to retest, in addition to the expansion of the apartment population to include 33,000 previously exempted units under the old standard, pollution remediation obligation for lead paying will increase from $2.6 billion as of December 31st, 2020, to $3.1 billion as of December 31st, 2021. About a $500 to $600 million increase right there. Now, as I mentioned, this takes into account the fact that we have to retest. The cost of retesting has risen substantially. We're taking more paint chips to be more cautious and make sure we don't miss anything. It's going to cost over $200 million to retest the whole portfolio. In addition, under the old guidelines, 33,000 units were HPD exemptions or otherwise taken off the ineligible list. We didn't need to test it. It was assumed that there was no lead to remediate or abate, but that assumption is gone under the new 0.5 level. So we've expanded the population very significantly. And those two items are included in this big jump in a pollution remediation obligation. What's not is what we can't estimate properly at this point. What is the positivity rate? So the city has agreed to provide incremental financial support to Nycha of $2.2 billion over a 10-year period, of which $772 million has been allocated to lead paint abatement, as per the May 8th, 2021 action plan. The $772 million will be recognized to revenue on a cost reimbursement basis over the 10-year period.
It's clear that those numbers are going to go up by inflation, aren't they? In addition to everything else, if it's a 10-year period.
Yes, they will.
So have you accounted for that in the estimation of the costs?
GASB 49 requires that you reflect costs based on current year costs. But we do have some disclosures in the note, I think that's note 7 in the ACFR, which talks about that the liability could be subject to changes due to price increases, vendor changes,
All right,
positivity changes, et cetera.
I remember now. Okay.
So that concludes the three major drivers which thread across the three large entities that we're about to discuss. I will dip into a few highlights for the statement of revenues and expenses and the statement of net position for each of the three entities. We'll just talk briefly about it. I'll take questions. I think you each have a package which includes those two statements in draft form, and basically we'll talk through the highlights. So if we go to Nycha, statement of revenues, expenses, and changes in net position, operating revenues have decreased by $50 million, about 5%, to $988 million. PACT 2020 developments, which are no longer at Nycha in 2021, caused about a $10 million rent decrease. So we're going to be seeing this every year. Rent is going to decrease naturally, even if everyone pays on time, because we have less developments and less apartment units each year. But rent reduction due to continuing growth in arrears is estimated at about $36 million. And this is partially due to the fact that 2020 rent collections were impacted by only 10 months of activity since COVID occurred. COVID started in March, while 2021 had the full 12-month impact. Operating expenses increased by about $66 million, or 2%, to $4,369 million. Maintenance and operations increased by $95 million due to increased salary costs, and also due to an increase in heating and cooling contracts and other building maintenance. Some of this maintenance was due to the fact that there was limited access to apartments in 2020. So certain maintenance wasn't occurring and was delayed until 2021. There was a big catch-up in 2021. Our rent for leased dwelling increased by $66 million due to higher payments per voucher unit and due to increase in number of units. However, this expense increase was more than offset by an $88 million increase in Section 8 Housing Choice Voucher Program subsidy. Depreciation increased by $19 million due to continued increase in building improvements. General and administrative expenses decreased by $104 million, primarily due to large increases in investment returns on the pension plan. Other post-employment benefits, Opeb, decreased by $54 million due to change in discount rate assumption from 1.93% to 2.25%. On the non-operating revenues for Nycha, they increased by $380 million or 14% to $3,141 million. Subsidies and grants, for most of this, they increased by close to $400 million, with public housing subsidy increasing by $125 million, Section 8 housing choice voucher subsidy increasing by $88 million, City of New York subsidy increased by $101 million, the federal capital funds used for operating purposes increased by about $91 million, and those are all positives. There was a slight offset, which was just a timing difference due to the CARES Act reduction, because in 2020, we recognized $130 million of CARES Act combined between Section 8 and public housing, and in 2021, we recognized $57 million. So we had a $73 million reduction there. But the important part is that we used the entire amount of CARES Act funding before the December 31st, 2021 expiration date. Also in non-operating revenues is the gain on real estate transactions, which was $39 million in 2021, decreasing $18 million from 2020. Decrease was largely due to the 2020 gain on sale of land and development rights on the Ingersoll development. In the special item, in 2021 reflects a $649 million increase in expected cost of lead paint obligations. And we kind of talked about what was driving that. In 2020, the authority actually recognized $201 million of gains in the special item, largely due to the change in estimate of the lead positivity rate from 32% in 2019 to 27% in 2020. Capital contributions were $758 million in 2021, down by $192 million from 2020, largely due to a federal capital fund decrease of $92 million and a FEMA decrease of $76 million. Net position is still strong at $1.62 billion at December 2021, down by $131 million from 2020. On to the balance sheet for the New York City Housing Authority. Total cash and investments were $1,638 million at December 2021 versus $1,747 million at December 2020, for a $109 million decrease. This is partially due to a use of Sandy resiliency funds and partially due to reduction in tenant collections. Capital assets in the aggregate increased by $390 million due to continued building improvement efforts. Deferred outflows of resources decrease of $267 million is primarily due to Opeb, both the increase in discount rate used and the valuation used for inactive employees. Unearned revenues, current and non-current combined, have decreased by $155 million, largely due to completion of much Sandy resiliency work where FEMA funds have been previously retained. Once work is completed, unearned revenue is reversed. Net pension liability decreased by $641 million, primarily due to large investment returns in 2021. For the same reason, there was a $603 million increase in deferred inflows of resources. Opeb liability decreased by $295 million, largely due to increase in discount rates from 1.93 to 2.25%, and due to change in valuation of how inactive employees were categorized and measured. And then pollution remediation liability, the current and non-current combined, increased by $573 million, largely due to the factors that we've discussed, the cost increase for testing and the 33,000 units which were formerly exempt under local law 1, which are no longer exempt from testing. So that concludes my presentation for New York City Housing Authority. Are there any questions before we go on to the next entities?
Heating and cooling contracts, that's a new item. Is that because you contracted out those as opposed to using existing Nycha staff to do heating and cooling?
I think there's always been a mix of that going on. You know, I mean, there's certain work is done by internal staff, but I think there was just more work that took place in 2021. You know, the drive to continue to improve the properties and to correct for the lost time in 2020 when a lot of work wasn't happening for different reasons.
Okay. Second, how is capital funds allocations used for operating costs?
I mean, there's an option to use it. I'm not sure I can answer that question completely, so we'll take a note and we'll get back to you on that.
Okay, because it's in the financials that.
Well, it is something that public housing companies are allowed to do as far as the actual decision as to how much it could be and what it could be spent on. That's something that I have to give you a little more information on.
Okay, maybe you were given an exemption or something by HUD, whatever.
But this is something that's kind of routine in nature. It happens every year.
Okay, thank you. And then finally, in these operating statement, operating expenses, where are pension contributions?
The pension contributions are in the G&A expense.
Okay, so they're part of general and administrative. They're not separated out like Opeb is.
OPEB is separated out, and pension is incorporated into other expense line items.
Okay, thank you. I'm done. Thank you.
I have a minor question here. You referred to the fact that there were non-capital financing. What are non-capital financings?
Non-capital financing. What was the context of that statement?
Page 12. Cash and cash equivalents provided and used in operating, non-capital financing, capital, and related financing. So I'm trying to understand what non-capital financing means.
Is this on the statement of cash flows you're referring to?
MD&A, page 12. Third paragraph under overview. Yeah.
Statement of cash flows?
It refers to non-capital financing and capital and related financing. I'm just curious as to what that means in terms of the difference between the two.
Jeff, if you want me to maybe jump in here. Non-capital financing, typically what I see in that section are subsidies or grants that are coming from other organizations, whether it's governments, federal government, the city, the state, that can be used in general operations. If grants or subsidies are received that are to be used specifically to fund capital assets, that's going to be in the capital section of the cash flow statement. So there are 4 sections of the cash flow statement, and it really depends on the use of the funds as to where it is placed on the cash flow statement.
I assumed as much, but it seems odd. Okay. Now, if I can, I come back to one of my favorite ones, and that is that you can't estimate the lead, but we know it's a big number, don't we?
We already have a big number. We have $3.1 billion. So yes, we know it's a big number.
No, but isn't it more likely than not that by the time you spend the money, it'll be a lot more than that?
Well, due to inflationary factors, as you referred to before,
Yes.
the answer is yes to that.
Well, shouldn't we say something about that to tell the reader that the number in there is questionable because we will end up spending a lot more and due to inflation, forgetting about finding more lead than we expected, just dealing with the existing pieces of lead. Shouldn't we say something about it? By the time we spend it, it'll be more?
We can certainly look at some more advanced language to cover that. I mean, as I mentioned earlier, we do refer to the fact that this estimate is subject to changes in price fluctuations and other changes in economics and vendor.
Well, I understand. All I'm trying to get you to say is it's likely to be a big number.
I mean, that's something that we probably can say in the notes, likely to be a big number if we can't quantify it. You know, we can talk about what the variables are that could cause it to be different from the estimate, and that there's a certain risk of uncertainty there.
Let me put it differently. If I were writing a prospectus and I had to deal with this thing, I'd put some language in that would cover the fact that it may turn out to be a large, directly it's a larger number, recognizing that you don't know how to get there, but you know it's big. All right.
It's a valid comment, and we will definitely consider that.
Now, in the pension, I raised this one earlier, the pension plan, we say that we did well, so it affected positively. We now know, and this gets me back to the event subsequent footnote, whether the current market conditions have reacted badly. We probably lost 15 or 20% of the value of the pension plans. Is that possible in today's world already?
I couldn't estimate that, but when you listen to the news and you watch the scoreboard,
Yes.
there's certainly a lot of risk there to everyone's funds. So, I mean, I think your point is, should this be a subsequent event disclosure?
Yes, yes.
And I think the answer is yes.
Oh, good. All right. Well, I've got another one that I wanted to talk about, and that is, when you're getting to subsequent event, is the inflation that's more than anybody ever expected, I think. And the headlines have the president doing everything he can in the Fed. Should that be also in the subsequent events?
We could have a general economic subsequent event, which will cover different potential variables and the risks on our business.
I think that would be protective.
Certainly touch on inflation and investment returns, and discount rates and insurance claims payable, and then the Opeb liability, et cetera.
Okay.
I mean, the market is going kind of crazy at this point.
Yes, yes, we're all poorer.
I apologize. I have to exit for a prior engagement that I couldn't get out of. Thank you, everybody. I'll see you soon.
Okay, acknowledge. All right, thanks, Emma.
Are there any other questions on New York City Housing Authority?
Well, if you don't mind, take a look at page 19. You're looking at 2021, when there was no change in the fair value of investments from the prior periods. How does that ever happen?
I think there's a switch between 21. Are you looking at the revenues and expenses on a gross basis?
I'm looking at program revenues.
Right, the requirement of that particular schedule is to gross up either in revenues and positives or in costs and negatives and separate it. So you can technically have a change in fair value of investments as a revenue in one year and as an expense in another year. So if you look down in the program expenses, you're going to see $13,320,000.
I saw
Program
that.
expenses. So on this particular layout, you don't see the revenues and expenses aligned on the same line.
Yes.
All right, but on our typical statement of revenues and expenses, they are. So on the package which was handed out to the audit committee members, you'll see there's just a very brief draft statement of revenues and expenses, and you'll see that the change in fair value investments is lined up on one line.
Okay, thank you. And if I may, there's a reference in here to, on page 15, actual earnings on pension plan investments partially due to differences between expected and actual experience. I think probably you want to say experience of what? The market?
I'm sorry, which
Page
page is it?
15. 1, 2, 3, 4, 5 bullets down. You say projected and actual earnings on pension plan investments partially due to differences between expected and actual experience. You're talking about on the investments or experience for what people showed up asking for pensions?
I think it's on the investments.
So do I. Think you could make it clear. No, it's just. No. Yeah. I'll give you a few little odds and ends where you don't capitalize the "the" in city.
Yes, well, please send all your changes over to us as soon as you can.
Give it to you in a bit.
Will we get some kind of revision sent to us when he makes any changes in this? Either a slight one-paragraph statement referring to where in the book it shows up?
Yeah, we can do that.
Okay. So that I can see what he's looking at.
One other thing, I didn't have a chance to go back and compare, but in the investment paragraph on page 28, you don't have all that lovely language about level 1, 2, and 3 here. I think you have it elsewhere. But I recently had an accounting firm tell me you put that in every time you have it. There was their style, but
I mean, our investments tend to be very simple. And
no, but you say someplace in here, you talk about level 1, 2, and 3, and these are all 1s or 2s. And I just didn't know why you didn't have it on that one place.
this is just a very simple policy. There's a separate investment in cash section, which goes into details about the actual transactions.
All right, you're satisfied. Now, there's another concept in here on page 41. You sort of talked to a high majority. What is that supposed to tell me? What's a high majority?
Can you tell us which paragraph, Fran?
41. First paragraph.
Is that the pollution remediation obligation notes?
You talk about the high majority which relates to lead paint. I'm not accustomed to seeing something referred to as a high majority. Is it 51%?
It's in the first paragraph.
Okay, well, I do see what you're referring to, but there's actually very specific dollar amounts referenced for lead paint.
I agree with you, but I didn't understand why you was putting you high as distinguished. All right.
Do you have some suggestions?
I don't have a suggestion. It's either a majority or a minority, but a high majority says, is it 85%? Whatever it is. I leave that to you, but it's something I hadn't,
I mean, it's probably 95% if I had to just guess off the top of my head based on
say
the,
most, it's something, all right.
based on the table on page 45.
Are you just suggesting to delete the word high, Mr. Kaplan?
You're not accustomed to having that, are you?
I'd suggest instead of high majority, say most of which relates to.
Accepted.
Now,
All right, so that's a substitute language. Can you put me on Jeopardy, please?
now, this is a stylistic question. You have things and you say et cetera. I'm not accustomed in this sort of situation when I write prospectuses to ever use the word et cetera, because it's on page 49. There's a couple of places where they say, I understand brickwork, windows, et cetera. When I write these sort of things as a lawyer, I wouldn't use that word. And I remember that the original charter of this audit committee had et cetera in it. It's one of the things we're supposed to do. And I called up and I said, what is et cetera? So I don't want to tie up with that little stuff.
It's a minor issue, but we can do a search for et cetera and determine where it's appropriate to replace it.
I'll give you the whole book. It's on page 49, though.
Can I raise a question? Let me put my mic on. The mortgage loans and any other debt that's being incurred is subject to operating revenues coming in to pay for that debt. In other words, it's subject to tenant revenue, right?
Or other sources of
Or
revenue.
other sources. So the question I have is whether there should be a caveat in terms of whether or not there might be potential defaults on those loans in the event that the operating revenue is not coming in due to all of the reasons that have been stated earlier about tenant revenue reductions. In other words, is mortgage and bonds repayments subject to the same risks as the general fund?
There are certainly certain risks in the debt portfolio. On the other hand, the cash in investments that we hold are $1.6 billion. So we have adequate cash and investments at this point in time to pay off all debt service and any other expenses. So there could be a point in time in the future where there's a greater risk, but at this point in time, we're not particularly concerned about that.
Does the city of New York back up those bonds in addition to Nycha in the event that there's a default?
I don't believe so.
So Nycha is solely on its own in terms of paying,
Yes.
paying for those bonds? Okay, thank you.
Now, apropos of that, there's this big disclosure having to do with employee benefits and all that good stuff. Is the language in here consistent with what the city has in its financial statements? Have you read one against the other so that there's not inconsistency between us and the city?
I don't think it's been mapped on an annual basis, but going back several years ago, there was a kind of a mapping of the process to make sure that we had similar tables and disclosures as required. Over the years, it's probably evolved, and it's something that we can take another look at and determine if it's consistent. But of course, the dollar values in their OPEB and pension plans are monumental compared to ours,
Certainly.
and they require a lot more disclosure.
Well, but all I would suggest is that to the extent somebody looks at it, that there's no difference materially between what we do and what they do, because again, the lawyer in me says you don't want to have two organizations that are part of the same structure, really, that have different descriptions of what they're doing, just as added precaution. That's what you get for putting a lawyer on the audit committee.
Go ahead and take it.
Mr. Koo,
Yes.
You were asking about the bonds, if they were backed by the city.
Yes.
Just wanted to kind of clarify, I mean, those are backed by the federal government HUD through future capital fund allocation for Nycha.
Oh, okay. Okay, thank you.
Just for
That's what I wanted to know.
Thank you.
Thank you.
Oh. Every economic board I'm on had something in the events subsequent having to do with Russia's invasion. We don't. Are we comfortable that there's nothing that what's happening there affects us that should be an event subsequent? I don't have a view, I just raise it.
Well, I guess it depends on what we want to attach the inflation and the other economic woes that we're having in the U.S. and globally to the Russian invasion. But I think we are going to cover with a new subsequent event disclosure all those effects on investments and pension plans and inflation of costs, et cetera. I don't think it really matters what the cause of it is. It's more what the impact is on our portfolios.
I'm only asking whether I have no experience with this. I had sit on 2 other audit committees where we are talking directly about the impact of the war on commodity prices, for example. So I raise it if you're comfortable. I'm just asking out of curiosity.
Okay. Well, if there are no other questions,
I'll give you this, Mark.
please. My homework assignment.
You think I get pleasure out of reading this?
Yes, you do.
No. You should try the city one. It's that thick.
All right, thank you very much, member. We will move on to item 4. And that is the Nycha Public Housing Preservation LLC 1. That is the annual comprehensive financial report for 2021.
So we'll go through a very quick walkthrough of the statement of revenues, expenses, and changes in net position, and then the statement of net position after that. We're going to see in the next 2 entities a lot of the same commonality relating to business drivers. Tenant revenue is down by $5 million due to economic impact, largely of COVID. Total operating expenses are up by $11 million. Maintenance and operations expenses within are up by $15 million, of which half is due to heating and cooling contracts. And the other is due to maintenance that may have been delayed because of COVID-related access issues. And much of the rest of the expense increases are due to higher salary costs. General and admin expenses decreased by $9 million, mainly a one-time reduction in Nycha management fees. Utilities are up by $5 million. Subsidies are down by $9 million. While there are various offsets involved in the subsidies going in opposite directions, what falls out is a $9 million CARES Act funds, which was allocated to LLC 1 in 2020, with none allocated to LLC 1 in 2021. Special item in 2021 is a $59 million expense due to increased lead testing costs and the need to include previously exempt units under Local Law 1. In 2020, there was an $11 million gain in the special item due to the expected reduction of positive lead results from 32% in 2019 to 27% in 2020. On to the statement of net position for LLC 1. Cash is down by about $28 million. Note the 2021 loss before special item and capital contributions was $55 million. But after backing out $27 million depreciation, which is a non-cash expense from the $55 million loss, this provides for a $28 million cash impact, roughly equal to the change in cash balances from year to year. Capital assets decreased by $19 million, largely due to the $26 million depreciation during 2021. The only significant change in the liabilities is a $50 million increase in its pollution remediation obligation for the lead paint test issues that we discussed before. So are there any questions on LLC 1 before moving on?
No, he can probably skip right over two. It's the same thing, isn't it?
LLC 2 has some unique aspects to talk about. Terrence, do you want to introduce it? Or?
Okay. Okay, we go to item number 5 on our agenda. That is the Nycha Public Housing Preservation, LLC 2, Annual Comprehensive Financial Report for 2021.
All 8 of LLC 2's original developments have been subject to the PACT initiative through December 31st, 2021. The final 2 developments, which were transacted on December 28th of 2021, just a few days before year end. For each development, the ground leases between Nycha and LLC 2 were terminated. The capital assets and mortgage loans payable were transferred from LLC 2 to Nycha, and the loans payable to Nycha were forgiven. This resulted in a $50 million loss on transfer of assets and a $25 million gain on forgiveness of debt on the LLC 2 21-21 financial statements. However, in consolidation of the component units, these large gains and losses all offset on Nycha's financial statements. As of December 31st, 2021, LLC 2 assets and liabilities are limited to cash and cash equivalents due from Nycha and other current liabilities. Going forward, LLC 2 is expected to have minimal revenues and expenses. Expenses like legal fees and audit fees and tax filing fees may continue for a while. Tenant revenues are roughly flat to 2020, despite reduction in collection from tenants, largely due to the tenant receivables, including arrears, were transferred to Nycha onto PAC transactions at or near face value, when prior valuations had anticipated large collection losses. Total operating expenses are down by $17 million, primarily due to the continued transfer of developments to Nycha. Subsidies recognized also down for similar reasons. And the special items have a strange twist in LLC 2 because there are gains, there are reversals in both 2021 and 2020, largely as a result of transfer of the developments to Nycha and the corresponding reversal of the pollution remediation obligation for lead paint. So with that said, are there any questions about LLC 2?
I have one about both of them. When we talk about the pollution remediation obligations, are those disclosures consistent with what the parent has? I didn't read one against the other, I'm just asking.
They are relatively consistent. They don't have every aspect of it because they are not subject to some of the funding relief which LLC 1 and Nycha were able to receive from the city of New York. They're not subject to some of the subsidies because they don't have any public housing in their entity. They don't receive public housing funding. So there are some unique differences there, but in general, they're similar.
Okay. I have no further questions, gentlemen.
All right, thank you, everyone.
I just have one question, and that is on page 8. Why was there no loss of tenant revenue between 20 and 21?
Are we talking about an LLC?
Why was, yeah, LLC 2 on page 8, I think?
Yes, that's a good question.
An increase, it was an increase in tenant revenue, as a matter of fact. How did that happen?
So there's a slight increase. There are two opposing factors going on in LLC 2. First of all, as in all the developments, rent collections are down. But the other side of the transaction is we book substantial allowances for doubtful accounts on the arrears piece. And when those receivables were transferred back and then eventually transferred to the developers through the PAC transaction, they were transferred at very small discounts on face value. We haven't always had that in every transaction. In some cases, we get 50% on the dollar or less. But in 2021, we received close to 100% of the face value of the receivables, even though we had allowed for 90% of that as a potential loss. So we ended up reversing previous losses incurred in prior years as a result of the transaction. I guess in simple terms, if we had one tenant which had a $500 rent due, and we had made the assumption through an estimate that we wouldn't receive any of that money, we put an allowance aside for $500. Then when we actually transferred this back through Nycha, we got the full $500 back. So it artificially, changed the net tenant revenue from lower to back on track.
Okay. Yeah, right. It's like paper transaction, right? Almost, as opposed, right?
Yes.
Okay, thank you.
What's next?
Okay, thank you very much, Jeff. We will now move on to the Deloitte's Audit Committee letter, that is a SAS letter, and Management Representation letter for 2021 audit. Jill?
Thank you. Members, my senior manager, Darshan Patel, is handing out a revised management representation letter. You have one attached to our letter, but there have been subsequent changes, and so wanted to share those with you today as well. So I'll take you through our annual required communication letter related to the results of our audit. So Deloitte is currently in process of completing the audits of the financial statements for the 3 Nycha entities. We audit those financial statements in accordance with 2 sets of standards, the auditing standards issued by the AICPA, as well as government auditing standards issued by the Comptroller General of the United States. And we expect to issue our reports on the financial statements dated June 23rd, 2022, so this time next week. The objective of an audit, as a reminder, is to express an opinion on the financial statements and whether or not they're presented fairly in all material respects in accordance with GAAP. We do specify procedures on the required supplementary information. The document just handed out.
Yeah.
What the changes are between the one we got in the book and this?
I can certainly send that around after this meeting. I can do that compare and send it to you. This authority's significant accounting policies are set forth in Note 1 to the 2021 financial statements. We are not aware of any significant changes to previously adopted accounting policies or their application during 2021. Accounting estimates are an integral part of the financial statements prepared by management. In Appendix A to this letter, lists out some sensitive accounting estimates related to pension claims and Opeb, and we can talk about those more in a few minutes. There were no material uncorrected misstatements or disclosure items passed identified during our audits. There were also no material corrected items brought to the attention of management as a result of our audit. We did not have any disagreements with management throughout the course of our audit. I do want to talk about one item that both management and Deloitte spent a good amount of time discussing during this audit, and it relates to Opeb. In July of 2021, the City of New York announced a change in the Opeb plan. They introduced a new plan called the Medicare Advantage Plan. This plan was initially expected to take effect on January 2022, with an opt-out period prior to that date. If participants in the plan opted out of the new Medicare Advantage plan, they would have to pay an additional premium to continue in the old plan. So there was going to be substantial cost savings to NYCHA by implementing this new plan, approximately $700 million of potential savings related to this plan. There were a number of litigation matters that went before a judge throughout the end of 2021 and into 2022. Ultimately, in March of 2022, a court ruled that NYCHA could not charge a premium for any participants who elected to stay in the old plan. So with that announcement in March of 2022, the plans to go ahead with the new Medicare Advantage plan were put on pause, and at this point in time, that plan will not go forward. As a result, discussions were held with management, Deloitte. I brought in some additional resources from my national office team to think through this matter and whether or not a gain should be recorded in 2021 and then subsequently reversed in 2022. Ultimately, the guidance under GASB 75, would state that as of 12/31/2021, which is the date of your financial statement, the substantive OPEB plan did not include the Medicare Advantage plan. So as a result, no adjustment to the OPEB liability was needed for 2021.
Tell me something. What is the language here that you put in the draft that we had on paragraph 16 and 17? It's new, and I'm not accustomed to seeing it. What occasioned that?
I'm sorry, Mark, what page are you on?
I'm looking on page 17 in your rep letter that you wanted from us. And items 16 and 17 are red line, indicate they're new.
Can we get there? Can I just finish a couple more remarks and then we'll move to the rep? Oh, just one more thing I wanted to bring to your attention. There are emphasis of matter paragraphs in Deloitte's opinions to the three financial statements. They are very similar to prior year with the exception of LLC2. Because of the PAC transactions that were completed in 2021, we did add an additional emphasis of matter paragraph to LLC2, which just describes that the PAC transaction took place and that substantially all of the assets and liabilities of LLC2 have been transferred. Our opinion is not modified with respect to this matter. It's still a clean opinion. It's just something that we as auditors feel is important to highlight to the readers of the financial statements. And so then moving to the management representation letter, 16 and 17 are new this year.
What occasioned them?
Yeah, so these two reps are in here because of the fact that we audit the financial statements in accordance with government auditing standards as well as AICPA standards. And so this year they are included in the rep letter. I also want to point out that the auditing standards did change in 2021, and so some of the reps that are highlighted here are a direct result of the standards in which we audit have changed in 2021. And with that being said, if you have had a chance to read Deloitte's opinion, you might have noticed that it looks different this year.
It does.
It does, right? And the reason for that is really bringing the opinion to the top of the letter. In the past, you probably had to read 2 or 3 pages of information in our opinion to get to the conclusion, essentially. Now that's stated at the very top of our report, in that it's a clean, unmodified opinion. It also goes into more detail around the responsibilities of both your auditor as well as management, all as a result of the new auditing standards that became effective in 2021.
seen that.
Yeah,
Question.
sure.
On page 6, where you talk about Nycha Public Housing Preservation 2 LLC, the last paragraph says, as discussed in Note 1C to the financial statements, all of the authority's developments have been transferred to Nycha as part of PAC initiative. Does that include the new PACs that were just set up?
Yeah, so that's why we added this paragraph in our report this year, is because essentially LLCT doesn't have any other, and doesn't have any more developments. All of the developments are now with Nycha, have been transferred back to Nycha. So going forward, LLC2 will have little to no assets and liabilities on their financial statements and minimal revenues and expenses recorded in future years.
But there was an announcement of all the recent PACs that was set up. There were new ones. So those new ones are under separate entities, no? They're LLCs set up with different names, et cetera. Williamsburg, I mean, and so those are not Nycha, right? Those are.
You're referring to the bundles, the new
Yeah, the
bundles?
new bundle, Brooklyn bundle, and this bundle, and, I mean, there's a whole new set of PACs that have been set up recently.
Yeah, so we have rounds of PAC transactions that have taken place over the last several years. And scattered throughout those were some LLC2 developments. We did 2 of the, I think it's six developments we closed in 2021, 2 of which were LLC2s. In the prior year, we actually closed 4 from LLC2, but many more from Nycha. But we've basically transferred 100% of the LLC2 developments through PAC transactions as of this point in time. So any new PAC transaction that take place will be from Nycha or LLC1.
Okay, so the clarification, I guess, I'm looking for, is this, when you say all of the authority's developments have been transferred to Nycha, you mean all of the LLC2 developments?
Yes, and I wanted to, I'll make that.
It looks like citywide, everything is being.
I'm sorry, what are you referring to?
Well, this statement, as discussed it says all of the authority's developments have been transferred to Nycha. I don't think that's correct.
So I'll talk to that, Mr. Koo.
All of LLC2 has been transferred,
So.
all of the developments.
So these paragraphs that are required to be in my letter, these are from my letter to the audit committee. These are taken directly from the auditor's reports for each of the entities. So in LLC2's opinion, auditor's opinion, it's referred to as the authority. So these paragraphs are taken directly from the standalone opinions. And so in what you're reading here is very specific to LLC2. If that makes sense. Right, this is my letter to you, right? This is my letter to you, and in my report on the financial statements, this paragraph, as you read it now, this paragraph will be in my opinion on LLC2, and that's because in that opinion, we define LLC2 as the authority. Because it is a standalone organization, and for purposes of reporting on LLC2, it is defined as the authority. This paragraph will not appear in the Nycha consolidated opinion.
Got it. It's only the letter to.
Only in the LLC2.
Now, I want to go back to something you said, where you said that they all went back to Nycha. When you say they all went back to, I was a little confused as to who you were referring to. What went back to Nycha?
LLC2
Right.
doesn't have any developments going forward. So there's no, correct me if I'm wrong, Jeff, but there's no revenue generating developments at LLC2 going forward.
That's accurate.
So,
Why do you keep it alive?
I'll get back to you when I formulate the question that I'm actually looking for. It was, I don't get it. The whole theme is, and I'm just got to say this, the whole theme is going from Section 9 to Section 8. So when you go Section 8, you're no longer considered NYCHA. You're considered Section 8. Now, the LLC 2s, were they considered Section 8 or were they Section 9?
Mr. Gonzalez, for the PAC transactions, so if you look at it, it went from LLC 2 to NYCHA, and NYCHA did the PAC transaction with the developers.
Okay.
So I mean, the transaction is with NYCHA, not with LLC 2. So the developments were reverted back to NYCHA, and then we did the PAC transaction. And I think that's the flow of the transaction.
Yeah, that's kind of throwing me off because in my estimate, the way it's supposed to be, it's all NYCHA. So, you know, this whole Section 8 and Section 9 and what's going back and forth, it's a little confusing because, again, NYCHA refers to Section 8 as Section 8 and not NYCHA. I mean, that's what we've been told. So this way, when you say that it's going back to NYCHA, it's a little confusing. Okay, but I understand what you're saying now with that added section. Okay, but I just wanted to be clear.
So does that mean that we're not going to see LLC2 anymore in terms of reporting?
The decision hasn't been made. There'll be at least one last year at a minimum, 2022, because we still have money in the bank account. We still have miscellaneous accounts that need to be settled. There will be tax returns and audits and other type of things that have to take place. You know, whether or not that continues, you know, is still to be seen. We need to review it with legal and with tax and other implications and make sure that we do the right thing. But I think what we do know is that there'll be little to no activity in the entity in 2022.
Having said that, do we have a contingency plan as to if we have any surplus left over? I mean, where is that going to go?
We have not evaluated that.
Okay.
And that seems unlikely under the circumstances.
All right. All right.
All right, any further question on the Deloitte?
One last.
Okay, Mr. Koo.
What management representations are you looking for? And why are they still in the process of being sent to you, or are you still waiting for them?
So within that's the management representation letter. I originally, the one in your packet that you received in the mailing, there were modifications, I would say mainly minor modifications to that letter. And so I wanted to share with you the letter as it reads currently with some subsequent changes. So that's what Darshan handed out today. And I can certainly, at Mr. Kaplan's request, do a compare and send that to you electronically, showing exactly what changed from the version in the mailing.
Yeah.
You're welcome.
Okay, thank you very much, Jill. We have had it from the auditors. Now it's time for us to entertain a motion that these reports be recommended for approval of the audited 2021 financial statement to the New York City Housing Authority Board.
I move it subject to the minor changes we'll give them.
It has been moved subject to change. Second? It has been seconded by Mr. Koo. All those who are in favor? Aye. No opposed? May the record so reflect that. We're going to move right into Deloitte status update on the 2021 single compliance audit. Jill?
Thank you. So in your materials, you have a short presentation related to the single audit. We are in the early stages of that audit. Darshan Patel is my senior manager who leads the efforts on our compliance work. And at this point, we have received a preliminary schedule of expenditures of federal awards, a CFA, from management for 2021. And we have gone through our preliminary risk assessment to determine of the grant programs listed on the CFA, which one we consider to be major programs. And at this time, we are planning to test 3 grants as major federal programs for 2021. The first being the Housing Voucher Cluster, which is comprised of 4 ALN numbers. The second grant program will be the Public Housing Capital Fund, ALN 14872. And the last one being the Public and Indian Housing Grant, which also includes an element of CARES Act funding. So those 3 are the 3 programs we'll be testing this year. At this point in time, we have requested populations for our compliance work from management, and we'll continue to perform test work through September. The single audit reports are required to be finalized and issued and uploaded into the Federal Audit Clearinghouse by September 30th, 2022. And that's my update on the single audit, really early stages. But any questions, I'd be happy to answer them.
All I have is this. I probably asked it before. I guess I'm getting older and I don't remember it. But exactly how many GASBs are there?
100.
And of those, how many do we utilize?
Good question. Definitely not all. There are many GASBs that are not relevant to your organization. But I don't know exactly how many are impactful to Nycha's financial statements.
And then the final thing is, I guess we use them as, who is it, the governor or the state or the guy that general accounting, when he decides we need to use one, we use it? Is that how it works?
Yes, because Nycha is a governmental entity and you follow governmental accounting standards board statements. So those are the accounting statements by which you prepare your financial statements. If there is a relevant GASB, then Nycha is required to follow such accounting literature when recording transactions and reporting information in their financial statements. Contrary, if you're in like a private company setting, not a government, they follow what you refer here to as FASB standards, Financial Accounting Standards Board statements. So GASBs are used by most governments, Indian tribes, counties, public authorities, things, organizations such as that.
This is going to sound like a silly question, but I have to ask it anyway. So are we given ample time? When I say we, I mean Nycha. Are they given ample time to address any new GASBs that we're going to use so that we can accommodate the federal government or whoever it is, whatever entity is asking for this information?
Generally, yes. Generally, when a standard is issued, and there were just 2 standards, GASB 99 and GASB 100 were recently issued, and I believe that implementation for Nycha is 2023 and 2024. So you have anywhere from 12 months to 36 months essentially to implement some of these standards. So they usually give you enough time. And then there were some standards like GASB 98, which changed the acronym CAFR to ACFR. That was I think an immediate implementation because it required little effort or work to make the change. So not as much time was given to implement it, but that made sense, right? It didn't take a lot of work to make the change. But anything that requires a heavy lift, such as GASB 87 with your leases, you've had years to implement the standard.
And now I turn to Nycha. In this report, I was reading certain things that we're addressing as far as the layered access, the CCTVs. And lately, there's been problems with that. And I'm wondering how we're addressing the situation. And I was wondering, as far as audit is concerned, if you guys can come up with something that will shall we say, describe how the layered access is supposed to operate as opposed to the way it's operating now. I've run into, on some site visits, I've run into some issues, and I'm a little concerned, so I need to know, what is the actual procedure of the layered access and what it's supposed to do as opposed to what it's doing now.
Okay, Mr. Gonzalez, we can look into that and respond to you accordingly. Definitely.
Jill, before I let you go, in the minutes of the last meeting, it refers to, despite, quote, great resignation, close quote. What was that great resignation? Too many people here? What did it mean?
I'd have to go back to the minutes.
Well, the minutes say that you said, despite, quote, great resignation, she has managed to keep the same team together. I'm just curious what great, sounds like a biblical act.
I mean, I think right now, just in general, many corporations and entities are going through a great resignation period. We have employees moving.
That's what you're talking about.
Yes, I believe that's what I was referring to.
I take it we're not do it wrong each time. We're not going to talk about the internal audit stuff today.
No, but should you have any questions, you can prefer them now at this time, and we will certainly respond to you. Okay?
Do we want to have an executive session here without the auditors, without any management or otherwise?
I don't know, do the members feel like we need one?
I don't think so today. Then would you like a motion to adjourn, sir?
Quite in order.
I move it.
It has been moved. It has been seconded. All in favor?
Aye.
Aye. Okay, we want to thank you very much, all persons who have attended this Nycha Audit and Finance Committee meeting, and our next scheduled meeting will be on September 13, 2022. Thank you very much and have a wonderful day. September 13.